Stop blindly going long on oil. Venezuela is no longer the Venezuela it once was. If you think that a president being arrested or a regime change automatically means oil prices will surge, then you may be living in the past. Such a major event has happened in Venezuela, so why did global markets react as if they were just watching a spectacle, with oil prices barely moving at all? Today, let's talk about this counterintuitive phenomenon. Hello everyone, this is Ultima Markets. This Wednesday, the monthly reports from OPEC and the EIA are about to be released. In theory, market attention should be firmly on oil right now. But we all know that the biggest recent headline is actually Venezuela, President Nicolas Maduro being taken away by the US military. A geopolitical earthquake of this magnitude would have triggered a financial tsunami in the past. But strangely enough, this time neither crude oil nor equity markets seem particularly shaken. Why is that? Don't blame the market for being cold-blooded. The reality is that today's Venezuela has very little presence in the global economic landscape. It's like a once powerful heavyweight who now has less influence than a complete nobody. Back in the 1970s, Venezuela accounted for about 1% of global GDP and 8% of global oil production. Today, however, its GDP makes up only around 0.1% of the global total, while daily oil production has fallen to roughly 1 million barrels, just 1% of global supply, ranking about 18th in the world. Many people ask, even if production is low, it's still an oil-producing country, surely war should push oil prices higher, right? This brings us to the current energy landscape. After years of turmoil, Venezuela's real GDP has collapsed by about 70%. Although its oil infrastructure still exists, restoring production capacity would take years. It's simply too slow to solve any near-term supply issues. More importantly, the broader backdrop of the global oil market today is one of oversupply. Think of it like a vegetable market with too many sellers. If one stall disappears, nobody really notices a shortage. That's why you saw oil prices not only fail to rise last week, but even decline unexpectedly despite such major news. What does this tell us? That the market is highly rational and does not believe this event will change the fundamental supply-demand balance. So what does this episode actually mean for financial markets? We can see that capital has not been rushing around like headless chickens. Equity markets are still rising, especially AI and semiconductor-related tech stocks, which continue to move at their own pace. Investors have been reallocating more funds into safe haven assets like gold, rather than dumping their equity holdings. In fact, we are now in a state of geopolitical immunity. As long as global supply chains are not completely disrupted, investors have become accustomed to sudden geopolitical shocks. What matters more now is whether interest rates will fall and whether companies can make money, not which country's president has been replaced. This looks more like a geopolitical show than a real oil crisis. Finally, Ultima Markets would like to point out that while the US has said it intends to manage Venezuela and has not ruled out actions involving Cuba, as long as core commercial interests are not affected, this is essentially a storm in a teacup. This event is a reminder for all of us, in today's investment logic, don't blindly go long on oil the moment you hear about war. Understanding who truly holds the real leverage matters far more than just watching the headlines. This week's OPEC report will be out soon. Let's see whether the data confirms this view. This is Ultima Markets. Follow us as we help you see beyond the surface and understand the real drivers behind the markets. See you next time.